Hello everyone and welcome to Mirai Asset Sher Khan's monthly investment strategy update for January 2026. I am Vishal
and I am Akansha
from the Investment Solutions Group, and today I'll take you through the equity market performance, key global and domestic developments, debt market outlook, and finally our investment strategy and model portfolios for different investor profiles. Let's begin with the equity markets. Let's look at the broad market. Performance December 2025 proved to be a challenging month for Indian equities. Unlike the previous rally, broader market indices came under pressure with midcaps and small caps witnessing sharper declines. Nifty Next 50 was the only gainer, rising 0.33%. Nifty 50 declined 0.28%. Nifty Small Cap 250 fell 0.28%. Nifty Midcap 150 was the biggest laggard, down 0.53%. Global headwinds combined with rupee weakness kept markets largely range-bound.
Sectoral trends were mixed. During the month, metals emerged as the top performer, surging 8.5%, driven by strong industrial demand and global policy shifts. Commodities follows with gain of 3.3%. Auto and IT posted modest gain of 1.5% and 1.3% respectively. On the downside, defense declined 3.3%, consumer durables fell 3.0%, realty declined 2.8%, marking a sharp reversal after recent strong performance.
Valuation perspective. From a valuation standpoint, some moderation has emerged. Nifty 50 forward PE eased from 22.2 end of October to 21.2 December 31st, 2025. This remains above the 3-year average of 20.2, but the correction has improved risk to reward for long-term investors.
Institutional flows remained a key market driver. FII sold equities worth 17,500 crore in November and 34,350 crore in December. Rupee depreciation to 90 per USD was a major contributor to this outflows. However, domestic investors provided a strong support. DIIs invested 77,084 crore in November and 79,620 crore in December. This strong domestic participation highlights continued confidence in India's long-term growth story.
Globally, several key events shaped market sentiment. The Bank of Japan raised rates to 0.75%, triggering multi-decade highs in Japanese bond yields. This raises concerns around global liquidity as Japanese investors may repatriate capital in the US. Inflation cooled to 2.7% in November. The Federal Reserve cut rates by 25 basis points to 3.5 to 3.75% on December 10. However, the Fed maintained a hawkish outlook, projecting 2.3% GDP growth for 2026 and signaling only one additional cut.
India enters 2026 in a Goldilocks environment. QAFY26 GDP growth stood strong at 8.2%. Inflation cooled to around 2%, well below RBI's target. RBI cut repo rates 5.25% in December, adopted a neutral stance, announced Rupees 3 trillion OMO infusion and a $10 billion USD INR swap to ace liquidity. The rupee weakened past 90 USD, but this is expected to stabilize at trade negotiations. Progress and foreign inflows return. The key commodity highlights. Silver price surged over 150% annually, driven by green tech, AI demands and supply constraints following China export restriction effective January 2026.
CPI inflation rose to 0.71% in November from 0.25% in October due to seasonal food prices. WPI inflation stood at 0.32% year-on-year, reflecting lower food energy prices. The benign inflation backdrop allows the RBI to remain growth supportive. IIP grew 6.7% in November 2025. Manufacturing expanded 8% led by metals, pharma and automobiles. Mining rebounded 5.4% post-monsoon. 20 out of 23 manufacturing industries reported positive growth.
Bond market saw a split trend in 2025. Early optimism gave way to rising yields in H2. 10 years G-Sec yield rose to 6.59% as of December 31st.
Yield curve steepened. Short and eased long and remained elevated. RBI has cut rates 125 basis points in 2025 with another 25 basis points expected in 2026, keeping short-term yields attractive. India enters 2026 with strong policy support, lower taxes, benign inflation, attractive valuations. Growth drivers include PLI incentives, infrastructure spending, export competitiveness, and potential trade deals. Our strategy: large cap equities and select mid and small cap ideas remain preferred for long-term investment. Debt strategy: attractive yields at the short end of the curve. Accrual and short duration funds remain preferred. Tactical allocation to dynamic bonds, gold and silver recommended as diversification and hedge against global uncertainty.
Now, let's look at our model portfolios. Objective: long-term capital appreciation 5 years. Large cap 40%, mid cap 15%, small cap 10%, flexi cap 25%, thematic 10%. Objective: beat FD returns with controlled risk. Large cap 40%, large and mid cap 10%, balance advantage 10%, corporate bonds and short duration 30%, gold and silver 10%. Objective: capital preservation, corporate bonds and short duration 70%, balance advantage 20%, gold and silver 10%, 70% balance advantage, 30% multi-asset, suitable for 6 to 7% SWP or dividend option. 80% thematic sectorial, 20% flexi multi-cap, focus on India's consumption and manufacturing growth.
To conclude, despite near-term volatility, India's long-term equity story remains intact, supported by strong domestic fundamentals and policy support. Debt markets offer attractive short-term yields, while gold and silver provide diversification. No matter your risk profile, aggressive, moderate, or conservative, a disciplined, diversified, and a long-term approach remains key. Thank you for watching Mirai Asset Sher Khan's January 2026 investment strategy.
Don't forget to share this with fellow investors and see you next month.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.